Good afternoon, everyone. So, with the release of this month's edition, we celebrate 27th issue of Netra, that is 27 months of writing Netra. And I'm confident that Sahil will continue to lead the way for the next 27 years and beyond with the same conviction and dedication. In the midst of the global anticipation of a slowdown, as the effects of rate hikes gradually work its way through the system, and thus the higher interest payments weighing on corporate profitability, and the persistent high mortgage rates in the US affecting mortgage applications, it is noteworthy that India stands out as the least indebted nation amongst the major countries. To help put a more pronounced context around such complex data points, Sahil today will navigate us through the report, the Netra report, and provide his valuable insights. Over to you, Sahil.
Thank you, Pragati, and good evening to all of you. So today we'll do a two-part presentation today. First, I'll take you through the September edition of DSP Netra. Then we'll do a Q&A. We'll talk about all the questions that you will have. And then possibly once we are done with that, we'll come and talk about the DSP multi-asset allocation fund that we'll do at the end. So first, let's deep dive into the latest edition of DSP Netra. And we have seen that since we released it on 5th, today is the 11th. In the intervening 4-5 days, we've seen a number of comments and questions and insights that people have shared with us. So I would like to, address a number of them, talk about them, how we see data, how have we presented data. And then we're very happy to take questions on that. There is a Q&A tab. When you scroll the screen down, you can ask your questions there as in when I'm speaking, and I'll pick those questions up once my prepared remarks are over, and then I'll try and address all of them. So let's with the September edition of DSP Netra, and we'll talk about some of the most important themes and things. As all of you know, that 5th of every month we release this report, and the endeavor is to come out with the most important data points which are relevant at any point in time. So this time what we've done is that we've broken it down into 3 parts: US economic data, we think that it's very important, India valuation, and then we look at sector and opportunity. So these 3 things we'll discuss today. Let's first look at US valuations and data. So first is that US has been hiking rates for about a year or more now, and you can see that this red line, there are 2 lines: Fed funds effective rate, which is nothing but like an RBI repo rate. You see that rates have gone up. The Fed has raised rates from near 0% to 5.25%. And they are still not done. Maybe they are still talking about more hikes or, last hike, etc. The speculation is still on, but this rates have gone up significantly. What we've seen is that the corporate interest burden, that means the companies, when they pay interest on their borrowing, it is represented by this black line. You can see this black line. This is as a percentage overall of their profits, you can see. And this black line, as you can see, has fallen significantly, largely because of 2 reasons. One, interest rates have fallen significantly over the last 35 years in US. And you can see that whenever rates were increased in the intermittent cycles, the interest burden also went up. In this recession phase, you can see interest burden went up. In the 2017-18 cycle, when rates were being raised, interest burden went up. Even in 2000, when rates were raised, interest burden went up. Of course, there were other drivers as well at that point in time. But significantly, and more so in terms of the divergence, you can see that even after rates being raised, the interest burden on corporate America is yet to go up. And it goes up with a lag. And you can see very clearly that this lag is most likely about to end. The most recent data that we have has printed one more number, which is lower. But when we look at more high frequency data, when we look at P&L and balance sheets and corporate commentary and results, we know that this number has started to rise. This black line has started to go up, which means that the interest paid by US corporates are going to rise as interest hikes that the Fed has done hooks up into the system. The interest burden on US corporates will go up. This means that when you look at the US corporate picture, they have enjoyed very, very good profitability, specifically after COVID. And there are two, three specific reasons for it. One, the top line shot up because there was a massive stimulus. The costs were reined in because many companies went in for cost cutting measures. Eventually, in the last 1.5 years, even commodity prices have fallen, helping their margins significantly. And one more very large factor is the corporations delevered, that means they reduced their debt, and also the cost of debt fell significantly. All these numbers have now reversed. Okay, all these numbers, except low commodity prices, they are still more or less there. Other numbers have reduced. That means the ability of corporates to cut cost is no longer available in US. The top line has started shrinking, and this interest burden, as you can see there, the black line, it has a lagged relationship. As I said, with interest rates hike now being there in the system, we feel that this interest burden will also rise, which means the bottom line that US corporate profitability is most likely going to suffer and it is going to slow down. The second data point is what is happening in the US economy. So when you look at the US economy, a very large component of US economy is the US housing market. So real estate, both commercial and residential put together, is between 15 to 18% of US GDP, a very large contributor to US GDP. When you look at housing affordability in US, it's at multi-decade low, one of the lowest that we've seen. That means it has become very difficult to buy a house in US. It's becoming unaffordable. Second, very startling data point, in the last 2 years, the median income or qualifying income for getting a mortgage in US has more than doubled. You can see from $49,000, it has gone up to $104,000. And this is for a $331,000 home in US, which means that an average American has been priced out of the US housing market. So the incremental demand for US houses has started to go up, started to come down significantly. And that is one of the reasons why we believe US housing, which was a very large contributor to US GDP growth post COVID, is now going to reverse and it is now going to become a drag. This is also very true for US auto market. I will talk about that later. But one important ingredient in US housing is that mortgage rates are now at 2 decade high. In US, to get a fresh mortgage, you have to pay anywhere upwards of 6.5% interest. The headline rates are as high as 7.6%, which is very, very high. Although one very important point to note that most of the mortgage taken earlier are still priced lower. This rate is applicable to new mortgage. Most of the US market that we've seen in the mortgage market is largely, it functions on fixed mortgage rates. So the mortgage rates, although has not gone up significantly, but for the borrowers, but the new mortgage rates have gone up significantly. And therefore, higher qualifying income, higher rates, and unaffordability is now hitting new demand, new residential demand, which will add an incremental stress to the US economy. Right. Second is that so when you look at the US mortgage market, you will see that a huge amount of mortgage loans, mortgage was taken post COVID. As you know, huge stimulus checks were given. The US consumer had significantly improved balance sheets. And because of that improvement, what they saw was huge demand for housing loans. And you can see that this surge, and the data is going back to 2001. And it's very, very important to see that we have not seen this kind of a surge even during the go-go years of real estate boom in US. And this is something which is dramatically different. And the question is that today, a large part of US growth is dependent on this type of a number continuing, and which we already know that it is not sustaining, it has come down. So the US mortgage market, which is a key driver of real estate strength in US, we believe that this aberration, this once in a blue moon kind of a happen in the future. We have no idea to predict the future, but as we know currently, it's very, very difficult for it to repeat, at least in the next few quarters. And therefore, US housing again would be a source of drag on US economic growth. Third is very important parameter where I spoke about, talking about the US auto market. And I want to highlight two, three factors here. So first is when split up the US inflation. And if you look at two very important components, two components which have contributed significantly to US inflation, it is services CPI and shelter CPI. Okay, so services CPI is something which is a core inflation number X food and fuel. And this number has been very sticky. It has not fallen. Although US headline CPI, जो headline CPI inflation number है, that has gone down from 9.1% to about 3.5%. But this number has been very sticky. You can see that this number is still hovering around 6%, 5.5%, right? Shelter CPI, which is related to US housing, it is still very high, which is the rental driven inflation in US. And transportation services, again, a very, very important component. So when you split the core services CPI in US, which is the Fed is waiting for this inflation to fall. And it has not fallen. And why it has not fallen? One of the largest contributor to US core inflation is shelter, which comes from the housing market. In the last two slides, I explained to you that this number has started to fall. At least the US residential demand is going down. Even demand for rentals has come down. Rentals are on a year-on-year basis are now deflating, which means that they are printing negative numbers. So CPI shelter will come down. CPI transportation services, one of the components which was very, very elevated, largely because of supply side issues in two-wheelers, maintenance. And one very important, significant ingredient was motor insurance, motor vehicle insurance in US. You can see it has been rising, rising, and rising at a 17.8% YOY number. So we went and looked at all the companies which do and provide auto insurance in US, like GEICO, Progressive, State, etc. And when you read their results, what they are saying is that the cost of insuring a vehicle in US is still rising, but they are saying that it is going to rise at a slower pace than it did in 21 or 22. Okay, which means that the pace of increase of auto insurance rates is going to fall. Right now, it is at 17, 18%. It is a large contributor to US services inflation, and we believe that this will fall. And also, two very important points within this bucket. One, both core services inflation for rentals and for transportation will fall as growth slows. So we believe that this is going to be an outcome of a slower growth phase in US economy over the next 6 months to 12 months or so. And if the core inflation falls, which I think will start happening from November onwards, which means that the data that we'll get for November, which will be for October, will begin to show this declining numbers, and that possibly will indicate that US economy has begun to slow down. So this is going to be an outcome of the hypothesis that I presented to you in the last two to three slides. The next is the US employment picture, and US employment has been very, very strong, and we've seen that employment picture in some of the series that we track has started to deteriorate. So for example, ISM manufacturing and ISM services, both employment index are now more or less hovering close to contraction levels. Fed has delayed the rate hikes this time, as you can see. But the question is, has it overdone it? So if you see, there is an indicator called LMCI that I've mentioned here. LMCI is Labor Market Conditions Index. And Labor Market Conditions Index is also an indication which tells Fed to tighten monetary policy. So you can see that this blue line, when it crosses the neutral level, the Fed begins to hike interest rates. So in most cycles, the Fed has followed this model. But in this cycle, it delayed rate hikes and then increased them significantly. Now, what we are seeing is that the rate of change of LMCI, that means LMCI has already rolled over. It has started to come down. That means the labor market momentum or the conditions have now started to ease. And these easy conditions are possibly going to allow the Fed to step back. Okay. And when will it do? When you start seeing labor market data soften. Our estimate is that by the time we reach the end of the year, which is now 2 to 3 months, the labor market strength in US is most likely going to wane away. which is equivalent to the things that I said in the last 4 5 slides, that US economic growth will gradually slow down. Right now, it has been very strong. And similarly, you can see the job opening number that has started to come down. As you can see, it is very, very high compared to pre-COVID levels. So by no means do we mean that US employment picture has already deteriorated. What we are saying is that there is a possibility that it will deteriorate in the next 2 to 3 quarters. And similarly, there is SAHM recession indicator. This highlights when a recession in US can occur. Although we have no idea whether this will come true or not, but historically, when US unemployment rate goes up by zero point 0.5 percentage points, that means 50 basis points from the low of the cycle, usually US economy slows down significantly or enters a recession. Right now, the reading is 0.13. Okay, once the reading reaches 0.5, usually we'll see that the labor market strength will go away. And the monthly non-farm payrolls number is now 187 or so. So if you just look at the statistical number, there is a good probability that the moment that number falls below 100,000, there is a possibility that labor market strength will wane significantly. And this has been a very strong indicator for US. Most likely it will turn. And this is something that the data is indicating. We have to wait and watch and see whether this follows our line of thought or not, or how this data comes out in the next 6 months. So the key conclusion is that US economy most likely is slowing down, and we'll see the numbers slow down in the next few months and quarters. And incidentally, US market is also trading at a level where the valuations are not very attractive. US S&P 500 is trading at 20 time price to earnings. Nasdaq is trading at between 25 to 27 times to price to earnings. So the indices, headline large cap indices in US are also expensive. So our conclusion is that once the growth numbers begin to appear, US stocks will also begin to lose traction. And we feel that there is a possibility that US markets will correct in the next 6 months to 1 year. Okay. One thing is that what impact will it have on India? One thing is clear that India is now one of the least leveraged nations when you compare. So what we've done is here we've taken household debt, non-financial corporation debt, that means removing the financial companies, and the government debt. When you look at all the three numbers as a percentage of GDP, you can see Japan is the most indebted nation in the world among the large countries. And then France, Canada, Chile, China, US. You can see all these countries are indebted. India is more or less much less indebted. And this is one of the reasons why we believe that India will be able to navigate this high interest rate environment slightly better than other countries. Also in India, the inflation differentials are lower. That means our inflation is lower than what it was in the past and versus the other countries as well. So there is a possibility that India will have this backdrop of better stability through lower leverage and lower debt, but it cannot be true for many other countries. So in other countries where the system leverage continues to remain high, there is a possibility that this high interest rate environment and volatility will hit their equity markets and growth much more. And I think that period has already begun. So if you remember in the last edition of DSP Netra, we highlighted how quantitative tightening is now becoming more and more effective. That means at higher interest rates, central banks have started to cut back on their bond purchases, and they are actually selling bonds, which is squeezing out liquidity from the market. So countries which are highly indebted will be hit more. And this, I think, will become a reason for even the US markets to take a relook on their debt. And that, I think, dynamics can play out in the next 6 months or 1 year. And therefore, correction, which could be more global in nature, can be expected. Next is, so the data that I showed you on slide 1 on US interest cost burden is not very different from India. So I've tried to recreate the chart for India. You can see the private corporate interest burden, which is the orange line, and this is the repo rate, right? You can see that whenever repo rates are raised, after a lag, the corporate interest burden also goes up, right? It happens in all the cycles, right? It continues to happen in all the cycles. In this cycle, it will happen again. Interest cost will go up, it will compromise our profitability somewhat. But what we have seen is two things. One, our monetary policy remains, although it is at a cyclical peak, it remains less restrictive because we are still continuing to have high interbank liquidity surplus. Second, when you look at the corporate bond spreads, the point at which corporates are borrowing versus the GSEC, they are still very low. They are not very high. So that also tells you that monetary policy in India continues to be more favorable. Although um, it will become less favorable as corporates' balance sheets are, they will begin to pay more higher interest costs because the repo rate pass through will happen in the system. And this we think will happen, but it will still be lesser than the previous cycle. And that is something which is, let's say, over a 3 to 5 year, a big positive for India. So up until now, I have told you two things. One, there is a possibility that we'll enter a global correction, largely driven by US economic slowdown. Second, that India is maybe, it stands a chance to navigate this much more easily versus the past. And the reason for that is that our indebtedness is lower. We have less debt. Plus, our corporate sector is seeing the least restrictive monetary policy. Even when monetary policy has tightened, it has not hit our corporate sector significantly. And these two indicators will favor India. But, and when you look at the two, three key takeaways of what should happen in India, one takeaway is that in India, the inflationary cycle is much more disinflationary, right? We are going through a disinflationary phase. What is happening in the disinflationary phase? WPI is already negative, although it's now getting back to zero. CPI saw very, very sharp uptick and largely driven by the transitory food price inflation, which all of us know has fallen. In this month, we'll again see a higher number of 7% inflation. But in the subsequent month, as we already have the data, many of the commodity prices which have gone up, they have already fallen. So this number will fall back from this catastrophic level. And as we know that India is in a disinflationary cycle, every month gradually the GST collection growth rate, which was 12.5, 13%, is slipping by 50 basis points. So from 13 to 12.5 to 12 to now 11.5, it will keep on slowing down as the economy goes into a disinflationary cycle. And all these numbers are currently visible. Nominal GDP has slowed down. You can see in the latest numbers that were released. GST collections, the growth rate I'm not saying about the absolute number. Absolute number is still growing at 11%, 12%. But the growth, which was 13, 14, is now down to 11.5. It will slow down below 10% as we go ahead. It will also cause our banking loan growth to slow down to, let's say, 12, 13, 14% from upwards of 15, 16%. That number will also slow down. So a more disinflationary cycle is in progress, and this will get significant significant feedback loop from global slowdown. And when this occurs, I think in the next 6 months or 1 year is quite likely, India will have a better background of disinflation than most other nations. So that means we will have a lot more room to cut interest rates than many other economies. And therefore, what we are saying is that you should be buying duration today. We believe that 10-year GSEC at 7.2025 has a sufficient margin of safety with, there is a 75 bips difference between the repo rates. Second, Indian bond yields are now following US bond yields, although our dynamics are very different, as I showed to you in the last 2, 3 slides. So we believe that this is a good time to add duration. And in the DSP converse, we had already highlighted about 2 months ago that our stance is more neutral, that we are looking for high yields or better data to initiate that position. And I think now this is the right time to add duration in the bond portfolio, right? The next is on equity. So what is our call on equity markets? So debt, I spoke to you that you should be buying duration. On equity, our view is very clear. I think this is the time to be cautious. If you remember, in November and December, we had discussed why Indian valuations were attractive and Nifty was hitting about 17,000 or lower. Our valuations had, come closer to average, in some cases below average also. Mid and small caps were trading at a discount and looking ripe for a rally. At this point in time, what we believe is that we have hit an air pocket where valuations have become expensive. How to make sense of it? Okay, so two very important things. Historically, what we've seen is that when you buy a Nifty, when the PE is more than 22 times, the 3-year forward returns are 8.5%. Okay, this is what the backtested data shows. That means when you buy when the market is expensive, your forward returns are lower. When you buy when the market is cheaper, your forward returns are excellent. Okay, so put it in. So if I put it in one line, it means that if you buy a cheaper market, there is a possibility of getting better returns than average. Right now, we are not in the cheap category. We are hitting the top decile, top 20% in terms of valuations. And history tells us that from this point onwards, usually the returns are lower. So it makes more sense to be cautious today rather than being very aggressive. And we are seeing those signs of aggression in many numbers. For example, in absolute mutual fund flows, which have hit 20,000 crores, a very large number. We are seeing about 50% rise in small caps over the last 25 weeks. Again, a very, very peculiar reading that we've seen. We have also seen, Nifty trading at 22.7 time price to earnings. And this is a number which historically has happened only a few times. You can see that we've circled it out. It has happened many times, but the returns in all those periods are lower than the average long-term returns. Okay, that is the most important point to know. And if you go back in history, whenever valuations have been so high, your forward experience of returns usually falls, right? So I think this is the right time to be cautious rather than being very aggressive. And what are we prescribing? Stagger your purchases, equity purchases. In the last slide, I said buy duration, go for SIP or mix assets, right? Mix assets means go across assets to look at opportunities, and maybe we'll discuss one of that opportunity once this presentation is over. Next is banking, and let me also tell you that in the banking sector, we've been positive. In this calendar year, banks have not performed very well. They've been more or less market performer. But in the last 1 or 2 months, what we've seen is that results have continued to surprise positively, and banking valuations have not become expensive. Unlike a Nifty, where valuations have risen very strongly, in banks, earnings have kept pace with or even outpaced the valuations increase. And also, it's not universal. Within the banking sector, also, there are a few banks which are now trading at two standard deviation of their historical valuation. And there are banks, very large banks, which are trading at -2 standard deviation of their valuations. So, for example, HDFC Bank is trading at a 20-year low in terms of valuations. So, we believe that when the correction occurs, or if a correction occurs, banking will be a very important sector to increase or go overweight. Maybe not right now. Maybe as our expectation is that if the market corrects, this is one sector where you should look to raise rates. And this is something that you should be very, very attentive to. The reason is that valuations have become very attractive. And this is something that we look forward to. If the market corrects and there is a overall correction, this will be a go-to sector. The next is auto, and you can see that we put the top 4 companies. It's easier to tackle the two-wheeler sector because of the number of players it has. 2, 3 trends I will highlight. Cash flow from operations has started to improve significantly. You can see capital expenditure for one company is very high. But on the whole, the sector has restarted to do capex after slowing it down in COVID era. And you can see that capex numbers have risen significantly. Cash flows have improved. EBITDA margins have started to go up. Return on equity has started to improve. Net debt for most of these companies negative. That means they are cash rich. Their balance sheets are very strong. And you can see their profitability has also started to improve. So we believe that two-wheelers is a segment which again is attractively priced, and most likely we'll see a better outcome from this sector. Passenger vehicles, to some extent, we need to be very careful in terms of valuations. But two-wheeler gives out some comfort in terms of the way the financials are shaping up, plus also some of the companies where the valuations is more attractive and better placed. The next is engineering and capital goods, and what we are seeing is that everything is very, very good in this sector. Order flow, you can see order inflow growth as of the sector as a whole is 15%. You can see order growth in order inflow versus revenue, again very strong trend. RBI capacity utilization level hitting multi-quarter, multi-year high. So overall, the sector is very, very well placed. The companies are making a lot of money, but the problem is that it has become slightly expensive, right? And that is where the point is that historically we haven't seen most of these companies get such premium valuations. But as you can see, the numbers are catching up. So there is a dichotomy in terms of how to read this sector. We believe that stock specific stock selection is now the key for this sector. It cannot be broad brushed that capex cycle or engineering and capital goods, you cannot broad brush the sector by looking at it from a pure top down perspective. You will have to go bottoms up and company by company and be slightly more cautious in your approach when you look at a top down view in this sector, because the market is giving premium valuation overall to the sector, and that is usually a time to rethink and time to recheck all the parameters. The last is slide is on a behavioral nudge, which is a question on risk. And so what we believe is that there are two questions that you should ask yourself, and this is something which is even more true today. Okay, and what is the question? Whenever you take risk, ask yourself, can I afford it? Do you have the means to afford this risk? Right? Is it worth it? If even if the odds were in your favor and if it turned out to be what you wanted, will it make a difference to your life? Or the other way around, if things go wrong, what will it cost you? Right? Is it worth taking that risk? This is something which is very, very important. These two questions will prod you to think about the risk reward, the upside and the downside of risk. And every time when you come across an event where you have to take a decision, I think these two questions will be paramount. For example, even today, when you do a very aggressive equity allocation, think about it. Can I afford this allocation? Maybe in most occasion, yes. But is it worth it? Historical data shows maybe not. Maybe staggering our purchases, doing a SIP, or doing a mix of different assets could be the right approach at this point in time.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.